the much improved communications with Congress about the direction of monetary policy. And so I do want to take up this issue of Fed independence, because so much has been made in the media of President Trump's criticism of Fed policy in recent months, and his reference to quantitative tightening, his criticism of so-called quantitative tightening. As you will recall, many members of this committee, especially on this side of the aisle, criticized your predecessors for overly accommodative monetary policy for an extended period of time, so-called quantitative easing. And so what I want to just say is that my view is that all of this feedback from both the executive branch and the legislative branch is a necessary and constructive part of oversight, and is simply part of holding the Fed accountable, and that it in no way compromises Fed independence, since you and other governors are given 14-year terms with a provision that makes you removable only for cause. Do you agree or disagree with that?
I would just say it this way, that we're completely and totally focused on carrying out our jobs, and nothing really will distract us from that. Our accountability in our system really does lie, though, with this committee and with the other committee on the Senate side. So you have oversight over us. In a lot of other systems, it is the finance ministry. But in our system of government, it's Congress. Yeah, my only point is that criticism from Congress or the president does not, in my view, in any way compromise your independence. Mr. Chairman, I heard the economist Arthur Laffer say over the weekend that the Fed really doesn't set interest rates, that it follows interest rates. I thought this was an interesting comment, especially in light of low long-term rates and the inverted yield curve. Has the case for lowering the Fed funds rate strengthened because the Fed is actually following rates as opposed to setting them? You know, I wouldn't say that. I didn't see that comment, so I can't react to it. But I wouldn't say it quite that way. Our focus is on real economy values, in particular maximum employment and stable prices. So we use our monetary policy tools to achieve that. And we know that our policy works through financial conditions, so we look at a broad range of financial conditions. They do matter for us. What really matters is if there are big changes in financial conditions and they're sustained for a period of time.
Where are we today in terms of the proximity of the Fed funds rate to the neutral rate?
That's another one where we can only estimate the neutral rate, as you well know, and it's interesting. Estimates of that have come down as well. I would point out that we publish the medians in our summary of economic projections every quarter. We publish the medians of the committee, and that number has come down by 50 basis points since September of last year. So the median estimate is now 2.5% nominal, which would be about 0.5% real, and whereas it was 3% back in September. So we're learning. We're always learning about the natural rate of unemployment and about the neutral rate of interest. And right now, understand that it is estimated within fairly broad uncertainty bounds.
As you know, I've been critical of previous Fed positions or policy that I would characterize as overly improvisational. As you communicate and forecast where Fed policy is going, and you talk about in your testimony that the case for a more accommodative policy, that argument is strengthening. I appreciate that because I think it's habituating the markets as opposed to surprises, and I think that's very important for the stability of our financial system. Last question. You obviously cite in your testimony uncertainties in trade developments as perhaps one of the reasons why the case for a more accommodative policy has strengthened in recent months. What would passage by the Congress of USMCA and enactment of USMCA do in terms of the overall economic outlook and also the future trajectory of monetary policy?
I think it would remove uncertainty about our trade policy with Mexico and Canada to have that pass, and I think that would be a positive thing. Of course, I wouldn't comment on the particular merits of it. It wouldn't be appropriate, but I would say the passage of it would remove uncertainty, and I think that would help in the current environment.
I do have actually one final question, and that is, you had responded to my question about the GSIB surcharge, and you said that a proposal to simplify capital requirements for banking firms by integrating a banking firm supervisory test results into regulatory capital requirements. Where are we on that?
Moving forward, working on it.